ICP just give us two updates, Swiss subnet and Mission 70. The Internet Computer just dropped two massive catalysts back to back. First, Dfinity unveiled something called the Swiss subnet at Davos. This is a sovereign blockchain that runs exclusively on Swiss infrastructure through 13 independent nodes. The pitch? It's essentially a Swiss bank account for cloud data. Banks, governments, healthcare companies, anyone who needs GDPR compliance or jurisdictional control over their data can now run on a public blockchain without their information leaving Swiss borders. This directly attacks the biggest objection institutions have to public chains: data sovereignty. The second catalyst, Mission 70. This is a governance proposal that slashes ICP's annual inflation from around 9.7% down to under 3% by the end of 2026. That's a 70% reduction in the new token issuance. How? They're cutting voting rewards, reducing node provider payouts, and tying token emissions directly to actual network usage. Whale wallets have increased their ICP holdings by 30% in Q4, anticipating this scarcity play. Why does this matter? ICP has always had the tech, full-stack applications running entirely on-chain, no AWS required. But the tokenomics were ugly, inflation was high, and sell pressure was constant. Mission 70 fixes that, and the Swiss subnet opens doors to institutional clients who were previously locked out by public blockchains entirely. If they execute, ICP becomes one of the most deflationary smart contract platforms with a real enterprise use case. Next, Chainlink provide details on Swift Bank trial and CME futures. Chainlink just had one of the biggest weeks ever, and it wasn't about price action. Swift, the global messaging network that moves trillions between banks, just completed a landmark tokenization trial using Chainlink infrastructure. The participants? BNP Paribas, Intesa Sanpaolo, and Societe Generale's digital asset arm SG Force. This wasn't a sandbox experiment either. They settled actual tokenized bonds across both blockchain rails and traditional financial systems simultaneously. Delivery versus payout workflows, interest payouts, and the full bond life cycle, all orchestrated as a single process through Chainlink's cross-chain interoperability protocol. This is Tier 1 European banks using Chainlink to bridge traditional finance to decentralized finance in production. On the same day, CME Group announced they're launching Chainlink's futures in early February. There will be standard contracts at 5,000 link and micro contracts at 250 link. This follows record crypto derivatives volume on CME last year. Now, why does this matter? Chainlink isn't competing with other Oracle projects anymore. They're competing with legacy financial infrastructure. CME futures add another layer. Institutions can now hedge link exposure through regulated derivatives. That's the kind of liquidity and legitimacy that attracts serious capital, and Chainlink is becoming the connective tissue between traditional finance and on-chain markets. Next up, Ondo Finance, $2.5 billion in total value locked and a Solana expansion. Ondo Finance just crossed $2.5 billion in total value locked, making them the largest platform for both tokenized US Treasuries and tokenized stocks. Let that sink in a second. A crypto-native company is now the dominant player in bringing Wall Street assets on-chain. The latest move, Ondo launched over 200 tokenized stocks, ETFs, bonds and commodities on Solana. We're talking Nvidia, Amazon, Meta, Walmart. Blue chip equities now tradable 24/7 through blockchain rails with near instant settlement. Their flagship product, USDY, a permissionless tokenized treasury, just cost $1 billion total value locked by itself. It's live on 9 different chains and offers a stablecoin-like experience with actual yield from underlying treasuries. On the institutional side, State Street committed $200 million as anchor investor for Ondo's new money market fund. And next month, Ondo is holding a summit with JP Morgan, Goldman Sachs, BlackRock, Fidelity, and the DTCC's global head of digital assets all in attendance. What's more, the regulatory picture had cleared up too. The SEC ended a 2-year probe into Ondo without any charges. Now, why does this matter? Real-world asset tokenization is the narrative everyone's been waiting for. The global market for tokenizable assets is measured in the hundreds of trillions. Ondo is positioning itself as the infrastructure layer, the on-ramp for institutions bridging traditional securities on-chain. They have the regulatory green light, the institutional partnerships, and now the multi-chain footprint. If tokenized securities become a standard part of the financial system, Ondo is building the rails it runs on. Next up, we have Theta and their AI agent payments going live. Fetch.ai just launched something that's been theoretical until now, the world's first AI agent-to-agent payment system. Through their ASI-1 platform, AI agents can now complete real financial transactions on behalf of users, even when those users are offline. The system supports 3 payment methods: traditional Visa rails using temporary single-use card credentials, on-chain stablecoin payments with USDC, and native Theta token transactions. Each AI agent operates with its own dedicated wallet and user-defined spending limits. In the first public demonstration, 2 AI agents coordinated a dinner plan, booked a reservation through OpenTable, and completed the payment, all autonomously. No human intervention was required. The Visa integration is particularly clever. Instead of exposing permanent card details, the system generates one-time credentials for each transaction. That solves the security problem that's blocked AI agents from handling real payments in the past. Fetch also launched ASI Cloud for enterprise AI workloads and is rolling out autonomous agent payment capabilities for DeFi, supply chains, and data markets. Why does this matter? Because everyone is talking about the agentic economy. AI agents transacting autonomously using crypto rails. Well, Fetch just shipped it. This is the machine-to-machine commerce layer that makes AI actually useful in the real world. The Visa integration bridges the gap between autonomous AI and the payment infrastructure billions of people already use. If AI agents become a standard part of how we interact with services, this is the payment layer that they will run on. And finally, Theta Network, Imperial College, and an AI pivot. Theta Network just landed its first European academic partner, and it's a big one. Imperial College London's Security and Machine Learning Lab will now use Theta's Edge Cloud hybrid platform for AI research. This joins an academic network that already includes Stanford and George Mason University. But the bigger story is the pivot that's happening underneath. Theta launched a major governance proposal called T-Drop 2.0 that reallocates 4 billion T-Drop tokens from NFT rewards to a new staking pool. The goal? Extend staking incentives through 2030 and reposition T-Drop as the payment layer for autonomous AI agents on the network. This is a deliberate shift. Theta built its reputation on decentralized video streaming, competing with traditional content delivery networks by letting users share bandwidth and earn tokens. Now they're pivoting the same infrastructure toward AI compute. The Edge Cloud platform is getting upgraded with NVIDIA H200 GPUs for faster AI processing. Deutsche Telekom joined as an enterprise validator, and partnerships with sport teams like the Houston Rockets are deploying AI agents for fan engagement. Why does this matter? Theta is repositioning from decentralized YouTube to decentralized AI infrastructure and getting validation from elite research institutions. Imperial College isn't using Theta for a press release. They're using it because decentralized GPU access is cheaper and more flexible than centralized cloud providers for certain research workloads. If AI model training continues to explode, demand for distributed compute follows.